All right, thank you very much, Josh. So high-tech valuation, fears of a second wave of coronavirus, and uncertainty about the path of the economic recovery, and, of course, the impending November election, all adding to the whiplash on Wall Street this month. But what is the biggest driver of the market? Let's bring in Lindsey Bell, Chief Investment Strategist with Invest Ally, and Larry Adam, Chief Investment Officer with Raymond James, to discuss that. Lindsey, why is the market acting the way it's acting?
We had this really impressive run in summer right into the beginning of September. It increased valuations, just like you guys talked about, up to the 25 times mark on a PE basis. That's a level we haven't seen in more than 20 years. And I think that we are in a volatile month, and there's this lack of information flow. You listed out very nicely all the concerns that are on investors' minds right now, but those are concerns that have been persistent for a couple months now. So why the worry and focus now? Because there's a lack of focus on other things like earnings, for example, or especially one of the key topics is stimulus. We've seen that really removed from key headlines in recent days. So investors are looking for direction, and the market as such is acting in a bit of an erratic way over the last several days.
Yeah, it certainly does feel that way, and to hear you put a sharp point on it like that is I guess, comforting. Larry, let me turn to you, and obviously there are a couple of sort of binary trades. There's tech versus non-tech. There are consumer cyclicals versus non-cyclicals. And there's also the so-called reopening trade versus the stay-at-home trade. And on that, where would you put fresh money now? In the reopening trade or in the stay-at-home trade? Where is the greater opportunity?
Yeah, I would continue to put money with the stay-at-home trade. As I've been on the show before, we talked about that K recovery, where you want to be at the top half of the K, where you have visibility in earnings, and you can see where the earnings are being revised higher. And those stay-at-home sectors like technology, communication services, healthcare, and consumer discretionary, as you mentioned, that's where you're going to continue to see the best earnings going forward. So that's where I would continue to put it. And by the way, you mentioned tech. One of the things that people continue to talk to me about is that tech looks expensive, but I think you have to look at tech in the earnings sense in that we're going to have earnings season coming up here soon, starting October 26th for the big tech names, and they tend to come in about 7% above their earnings expectations. So that kind of draws back some of that froth that a lot of people think is in that sector.
Lindsey, let me turn back to sort of what's driving the market here. And the market has its own mind and goes off in its own directions. I would have bet, frankly, last night as I was watching what was going on in various cities across the country, that the market would have a hard time digesting the social unrest that we're feeling right now. There is a debate on Tuesday night. Who knows which way it's going to be and how nasty it could get. And there's an election coming up. There's a lot of uncertainty and restiveness and division in the country. The country seems to be raging in many ways. And yet the market is up 200 points today. Why?
Yeah, it's unfortunate, but history shows that the market doesn't typically react to social unrest. Now, I think the presidential debates, the VP debates, they can maybe have add a little more volatility to the market, at least around the days that those are on. But I think the market really is forward-looking. It's a forward-looking mechanism, and what they care most about is earnings growth. And stocks like to follow the trend in earnings growth. And what we've seen from earnings over the last several weeks is they're moving higher for 2021, believe it or not. And that's is contrary to what you typically see when it comes to earnings. You usually see numbers come down, especially into the next year.
And we had those good housing numbers, which are basically a terrific bellwether, I suppose, on the underlying health of the economy and the confidence of individuals. Let me turn back to you, Larry, if I might. Obviously, the election can affect the market. But what can the market and its actions in these days and months tell us potentially about the election?
Well, I think you bring up a great point, because if you look at the S&P 500, it's been one of the best predictors of who's actually going to win the election. If you go back to the 1920s, it's actually called the election 87% of the time. And the way it does that is you look at the performance 3 months before the election. If it's up, it tends to favor the incumbent. If it's down, it tends to favor the challenger. And if you think back to September 2nd, we were up about 7%. So that was kind of alluding to a very easy victory for the incumbent President Trump. But then when you look at the polls and predicted in the betting markets, that had a little inconsistent story there. So the fact that we've pulled back and we're right around plus or minus where we were, I think that that's more consistent with the fact that we are in a toss-up leaning towards a Vice President Biden win going forward. So I would keep a close eye on that indicator until we get to the election.
All right. Thank you very much to both of you. Lindsey Bell, Larry Adam, we appreciate your time today.